Hey guys, good evening. Good evening to all of you and welcome in this session of Oliveboard. This is Dr. Pradyumna Sharma this side, and today we are here to have a demo session related to crash and cracker batch. So we will be talking about this all-in-one batch or that crash in cracker batch. In this all-in-one batch, we will be having a detailed discussion on each and every concept. Remember, when we talk about the all-in-one batch or a complete set of batch where we will discuss some content plus we will discuss some MCQs that will give you uh, a one-time look into the subject and one-time practice related to examination pattern questions. So it's an excellent batch. But other than that, if you want to have complete support till the date of the examination, if you want to be with the faculties, if you want to have face-to-face guidance related to your exam preparation, then Super Elite is something which is an excellent plan for you. You can join that through the PDY code, and don't forget to subscribe the channel if you are new to that. The batch I'm talking about was all-in-one batch, and this is a demo lecture for this particular batch. This batch is a combination of around 80 lectures where we will cover content as well as we will cover some multiple choice questions, case study based, numerical based questions also. And in this batch, if you follow this particular batch in a systematic way, believe me, you will be easily able to crack the exam. So with that understanding, let's move forward with the discussion. Before going into the discussion related to topic, you have 4 modules in your syllabus. Module A is all about basics of accounting, and around 10-11 chapters are there. When we talk about the module B, the advanced level of accounting is there in your syllabus, and it do have around 7-8 chapters in it. Then module C is all about finance and knowledge of financial management, and this particular module will give you insight into the financial analysis of an organization. This also too have around 10-11 chapters in it. And then module D, which have around 6-7 chapters in it, it deals with 2 different aspects. One is taxation and another one is cost and things related to costings. Today, before going into the topic, we will be talking about the topic which is there in your module D, that is marginal costing. We will be talking about that, but before going into it, briefly understand the pattern of your exam. So there will be around 15 marks of the concepts in your exam, and tax and cost portion will always be based on the conceptual part. Numericals out of this module D will be of around 4 marks, statement based questions will be around 2 marks, and case study based questions will be around 4 marks. So module D have the mixture of concept, numerical, statement and case study based type of question. Because we are talking about the module D topic today, so I have just given you a brief idea about the classification of module D itself. Let's talk about the marginal costing. So marginal costing means what? First of all, understand that marginal cost refers to a situation, marginal cost refers to a case where your management or your accountant is suggesting that we should keep the record of cost per unit basis. What marginal costing is saying, that it is saying that measure and control the cost per unit basis. They are not saying that complete the total cost. On every next unit, what is your cost? That means if you are producing 100 units, and your cost was, for example, 1000 rupees. When you produce 101st unit, your cost is 1008 rupees. That means the cost of 101st unit is rupees 8. How we calculated it? Minus 1000. So that means when you are producing the next unit, your cost per unit, because earlier your per unit cost was rupees 10. Now your per unit cost is rupees 8. That means you are doing good. But if at 101 units, if your total cost is 1012 rupees, in that case the cost of 101st unit is 1012 minus 1000, that is rupees 12. That means your per unit cost is increased from 10 to 12. Now you need a detailed insight or analysis into it, that why this particular cost is increased, why there is an increment in this particular cost, why that 2 rupees increase. So marginal costing is a technique of costing. It's a technique of costing which focused on two major things. First, it is focused on keeping the cost records, and second one is focused on cost control. It is focused on these two things. That's marginal costing. The very basic formula for the marginal costing is delta C upon delta Q. That means change in the cost. It means change in cost divided by change in quantity. Let's have an example to understand it better. If in 2024 your total cost of the production was 5 lakh rupees, and which is in 2025 have increased to around say 6 lakh rupees, and your quantity production which you were making in 2024 was, for example, 50,000 units, or let's make it 10,000 units. Now the production of 10,000 unit have increased to like 12,500 units. So let's calculate the change first. The change in the cost is 1 lakh rupees, and change in the quantity production is 2,500 units. Now if we put the things in this particular formula, so the change in cost is 1 lakh and change in quantity is 2,500. That makes it rupees 40. So your marginal cost of the production is 40 rupees. This calculation they can ask from you in the exam. Tell me, in case you have any doubt, any query in any of this, please feel free to ask, and don't forget to like the session. Then What are the key features of marginal costing? First, very important feature, that marginal costing consider only variable cost. It do not considers fixed cost, only variable cost. It considers only variable cost as a part of the cost. That means it says that if you want to control your cost, you need to control only variable cost. You don't need to control the fixed cost because you can't control it. That's why it is called as a fixed cost. It classifies the cost into two categories. One is fixed cost, one is one is variable cost, but it focuses only and only on the variable cost. It do not focuses on the fixed cost. Second, it helps in valuation of the stock because it provides you that when you value your stock cost, which cost you should consider. So you should consider only only variable cost you should consider. Then it helps in calculation of profitability. Your organ, because when you know the cost per unit, for example, in the previous discussion just a moment ago, I told you that if your cost of the new unit is 40 and if you want to earn a profit of around 15 rupees on that, you can decide the price of the product. Rupees 55, that will be the price of the product. So deciding the price, looking into the profit and calculation of the cost, that's the key task or key features of the marginal costing, that price determination. Then the calculation part. So if you want to understand the calculation, let's have an example for that. Sales, for example, sales of a particular commodity is 15,000 rupees, and the variable cost, like the cost which is incurred in the production process, the cost of producing a particular product is 4,500 rupees. That brings us to a contribution of the organization, that is 10,500 rupees. So if we assume in this calculation, assume 3,000 units are produced. So if I divide 15,000 by 3,000, I have per unit sale price of rupees 5. If I divide 4,500 with the same 3,000, and if I divide the contribution margin with the same 3,000, so we have the contribution margin per unit of 3.5. It is useful for us in a particular calculation that I will tell you shortly, just wait. Then there is a fixed cost. See why I am not dividing 3,500 fixed cost with the 3,000. Why I am not doing this? Why I am not calculating the value here? Because what marginal cost was saying, marginal cost was saying us that consider only variable cost and ignore fixed cost. That's why we are doing this. Now, by making this particular income statement, we have the net income. We call the net income as a net profit also. Following calculations they could ask from you in the exam. First, they can ask from you the calculation of PV ratio, that is profit volume ratio. And the formula for the same is very simple, that is contribution divided by sales multiplied 100. Your contribution is 10,500 divided by sales, that is 15,000, multiply by 100. If you do this calculation, you know that your calculator is allowed in your exam. 10,500 divided by 15,000, that brings the profit volume ratio of 70%. Second calculation they can ask from you is break even point. Break even point. Now break even point formula is, there are two formula possible. One, when they ask that calculate the break even point in amount, in our this example we are using dollar. So if they ask in the amount, the formula is again very simple. Whatever fixed cost you have, divided by the PV ratio, which we calculated in the first calculation. If you put the value, fixed cost was 3,500 rupees and your PV ratio is 70%, you will straight away have the value 3,500 divided by 70%. That means when you make the sales of $5,000, when you make the sales of $5,000, your business will be in a situation where there is no profit, no loss situation. Break even means what? No profit, no loss in the business. But the second calculation of the break even point may be in number of units. So in number of units, the calculation is again, numerator will remain same, fixed cost, but the denominator will change. That is now contribution per unit. That's why this calculation is useful. If we put 3,500 divided by per unit contribution was 3.5 rupees. So 3,500 divided by 3.5, that brings us at 1,000 units. 1,000 units as a break even point in number of units. The third calculation they can ask from you is margin of safety. See, a very small income statement and three basic calculations based on that. The formula is again very simple. That is, whatever net income or profit you have earned divided by PV ratio. So your profit was $7,000 divided by 70% of PV ratio. That makes our margin of safety of $10,000. So $10,000 will be your margin of safety. This is how these three calculations they can ask from you in the exam, from this very small income statement. Please tell me in case you have any doubt, any query, anything in this. Sorry. Now, PV ratio we have already discussed. As per our calculation, our contribution was very simple. Contribution was 10,500 divided by sales was 15,000 multiplied by 100, we calculated 70%. Fixed cost divided by contribution margin, so fixed cost was 3,500 as per the question. So 3,500 divided by 70%, and we calculated it already, that is $5,000. Then margin of safety. So our profit was 7,000 and our PV ratio was 70%. That brings us to the $10,000 as a margin of safety formula and margin of safety amount. Tell me, any doubt, any query, anything in this? Remember, when we present these things in a diagrammatic way, especially break even point. So this is my sales curve. And this is my cost curve. Now, because up to this particular point, this is called break even point, and up to this particular point my cost is more than my up to this particular point my cost is more than my sales value. Cost is greater than sales, and that's why it is generating loss. So before break even point the organization generates loss, but after the break even point, this is the portion where we are, our cost is less than our sales and it generates profit, and we call that profit is margin of safety. This presentation is called break even chart. This presentation is called break even chart. Tell me, any doubt, any query in the discussion till now? There are some advantages of the break even point. Why we are calculating that break even point? Simply because you can take some decisions in a very informed way. You have the all information. You know that how much you have to produce to survive in the market. It encourages to improve the efficiency, because everyone who is doing the business would always like to achieve at least up to a point where he can be at least in not a loss situation. Financial forecasting becomes very easy because you already know that minimum production level is this. Performance monitoring, because every person who is generating break even point will become an efficient person or a profitable person for the organization. If you are generating loss, if you are not producing quality, obviously nobody needs you in the organization. Then risk assessment becomes easy. Assessing the risk in the market becomes easy. Cost management becomes easy for you. You know that how much you need to control. Marginal costing is everything about controlling the cost. This is how we will be discussing things in the crash course, and then we will do the practice for some questions. The question number 1 for you is in front of you. A manufacturing company producing a product with a selling price of 50 per unit, and variable cost is 30 and the fixed cost is 20,000. Please tell me, if a company sells 1500 units in a month, what will be the profit? What will be the profit? It's a simple case in front of you and we have to answer. See, simple. It's a question based on that income statement. Sales, that is 1500 units, multiply by 50. So $75,000 is my sales. Less variable cost, again that 1500 units multiply by 30. $45,000 is my variable cost. That brings me the contribution of $30,000. Currency, you maybe in rupees, maybe in dollar, in exam, doesn't matter. then we will reduce the fixed cost. $20,000. So we have the profit. That is $10,000. This is how our profit is generated. B will be my correct answer. That type of questions they ask in the exam out of this topic. Second question. There is a company XYZ Limited manufacturing electronic gadgets. Company have a fixed cost of $75,000 per year. Variable cost is $25 and the selling price is $50. How many units they need to sell for the break-even point? So units, they are asking in the units. So formula is, we just discussed the formula. Fixed cost divided by contribution per unit. How can we calculate the contribution? Sales per unit minus variable cost per unit. Let's put the values in the formula. $75,000 is my fixed cost. My sales per unit is $50 and my variable cost is $25. That brings $75,000 divided by 25. That brings me to the 3,000 units. So I have to produce 3,000 units to come up with a break-even point. So C is absolutely correct answer in that case. There is a company ABC Corporation, they wants to achieve a profit of $60,000. So profit target is already fixed. You getting my point? That in the income statement, you know that sales minus variable cost, that will bring the contribution, then we reduce the fixed cost out of it and we get the profit. So as per the question, targeted profit is already fixed. This is already fixed. Selling price per unit is 40, variable cost is 20 and fixed cost is 1 lakh. So 1 lakh is also given in the question. So if I do the reverse calculation, there will be a value of 1,60,000. The question is asking how many units must ABC Corporation sell to achieve the target profit? Because we already have the contribution in totality. If I divide this from the difference of selling price and the variable cost. Sale price was $40 and variable cost was $20. Obviously, when I reduce variable cost from the sales, I get the contribution. So if I match the contribution per unit with the total, I get the number of units we have sold. So $1,60,000 divided by 20, that brings us to the $1,60,000 divided by $20, that brings us to the 8,000 units. So D is absolutely correct answer. If 8,000 units are sold, let's verify that we are generating 60,000 or not as a profit. If 8,000 units are sold at the rate of $40, $3,20,000 is the sales amount. If 8,000 multiplied by 20 is the variable cost, so 1,60,000 will be my variable cost. If I reduce 160 from 320, I have 1,60,000 and then I reduce 1 lakh from it, I got 60,000 as a profit. So the expectation of the question is proved. Now In the question number 4, there is a company DEF Limited which is operating at 120% of its break-even points. And a very good question to have. DEF Limited is operating at 120% of its break-even point. The break-even sales are 2 lakh. What is the margin of safety percentage in it? It's very simple. First of all, because you are already generating 120% of the BEP and BEP is 2 lakh. If your BEP is 2 lakh, that means 120% of this you are already generating. So 2 lakh into 120%, that makes the sales of 2,40,000. That's your sales. Now question is asking about margin of safety. So if I reduce break-even point, from this, that's generate margin of safety, or I can say that this is the profit. So margin of safety is 40,000. Sorry. Now that $40,000, if I convert that in the percentage, sales was 2,40,000 multiplied by 100. 40,000 divided by 2,40,000, percentage is 16.67%. So A is absolutely correct answer. Tell me, in case you have any doubt, any query, anything in it, please tell me, let me know. Question number 5. Current break-even sales is 4,000 units. Selling price is $80. Variable cost is $50. If due to the increase in rent and the fixed cost rise by the $30,000, how many additional units company have to sell to cover the increased fixed cost? Simple. Your contribution per unit is $80 is your sales and $50 is your variable cost. So you are generating $30 as a contribution. Your additional cost, your additional fixed cost, if it is divided by the contribution per unit, you will identify the additional units simply. Your additional fixed cost is $30,000. There is some error in the typing. That's 1,000 units. Simple. 1,000 units will be the correct answer in that case. You have to produce 1,000 additional units to attain your break-even point. I hope you enjoyed the session. This will be the way we will be discussing our lectures in JAIIB all-in-one batch in English medium. First, we will discuss the concept related to the topic. Once the syllabus of the concepts is completed, once we completed this particular complete syllabus, then we will move to the next portion. I hope now I'm again audible and visible. So this is the all-in-one batch for you. You can join the super elite plan or the all-in-one batch. You can use the PDY code for that. If you use that code, you can join me in this particular batch, and we can prepare our concept in a good way. So I hope that that demo lecture is beneficial for you, and that is uh, give you a good insight that how we will be approaching this particular batch. Thank you guys, thank you very much for joining me. If you like the session, don't forget to subscribe the channel and like the session. We'll meet in the batches. Till then, have a great evening. Bye bye. Thank you, bye bye.